Hello everybody, Bill Bush here with Horizon Financial Group. Thanks for joining us for today's short presentation. Well, today we're going to be drawing a sharp distinction, one you may not have seen before. It's the distinction between thinking of ourselves as long-term owners of successful companies as opposed to being at the mercy of the stock market. And the question is, why is this distinction so important? Well, the answer is because it will help us maintain our perspective during significant market declines. Writing out the temporary declines in stock prices has historically been the key to capturing the premium returns. When the crisis strikes, don't confuse a drop in stock prices with a decline in the enduring value of companies. And so here's the mindset. Always think of yourself as owning enduringly successful companies rather than highly volatile stocks. That's the critical distinction I'm advising our clients here at Horizon to make, and I'm inviting you to make that distinction as you are watching this today. So in the long run, the most important element in investing isn't what the economy or the markets do, but what we do. These are our core beliefs, and we believe there are two great behavioral truths, and that is successful investors act continuously on a goal-focused long-term plan, and unsuccessful investors, they react randomly to frightening market declines. Look no further than the last quarter century, a gauntlet of crises, and we'll start with the dot-com implosion in the early 2000s. That was a 49% decline. After a rebound, along came the great financial crisis of 2007 to 2009. That represented a 57% drop. More recent history, 2020, of course, the U.S. and global economy was shocked by the COVID outbreak, where the S&P 500 dropped ferociously, 34% in a very short period of time. And then coming out of COVID, we had the period of hyperinflation and quick Fed rate spikes, which tumbled the market by double digits, a drop you see there of 25%. So, yet remarkably, $100,000 invested in the S&P 500 index at year-end 1999 had compounded to $731,000 by the end of September of 2025. Why? Well, simply stated, it's because all the crises passed away and because superior companies continue to innovate and prosper as never before. So this is what I call the package. Here we go. The historical return of equities, an average annualized return of 10%, has been punctuated by an average intra-year drawdown of about 15%. In other words, the investor had to endure an average intra-year drop of 15%, some pain there, to realize the annualized return of 10%. And about every 5 years, by the way, there's been a bear market, which averages about a drop of 30%. Now, you've probably had these thoughts one time or another. Wouldn't it be nice to capture the long-term growth and be able to go to cash right ahead of the drops or the declines? Well, this is a bit of a fool's errand, of course, because of the fact that the economy, can't be consistently correctly forecast, and the market cannot be consistently timed. So, what does this mean for investors? Well, the only practical way to capture the full long-term returns of equities has been to ride out the declines. Another way of looking at it, and this solid, consistent behavior gets rewarded over long periods of time. Solid, consistent behavior getting rewarded over long periods of time. The long-term premium returns can't be separated from the declines, and that's what I mean when we talk about the package. They're packaged together. So here's a question. What prevents investors from embracing the package? And the answer is usually this. 4 words. This time is different. Human nature initially perceives each new crisis as being potentially fatal. So the 4 most dangerous words in investing, this time it's different. It's from one of the great investors and philanthropists of all time, Sir John Templeton. And it's true, every crisis is significantly different from all other crises in history, but they've never yet been different where it counts. So look again at the crises we talked about, the dot-com, the global financial crisis, the COVID shutdown, the hyperinflation, etc. Each one totally different in cause, of course, from all the others. And yet, here we see, after each crisis, the growth in companies' earnings, dividends, and share values has always resumed and actually achieved new heights. That's why this quarter century has been such a great teacher for the serious investor. Let's look again at companies versus stocks in our everyday lives. So a thought experiment here. If you can name 10 companies whose products and services your family uses virtually every day. Every day now. Think of who makes your cell phone, your car, maybe your laptop, laundry detergent, some of the services that are provided to you, on and on and on. Think of those companies for a sec, and what would be in your top 10? Who are the companies that make up and make those goods or provide those services? And now think of this. All right, got them on your mind? Here we go. Consider these two questions. Will you use these companies' products and services any less if their stocks go down 50%? And the second question is, do you think many other people will use them less? So once again, we should always think in terms of companies, not stocks. All right, and finally, just a couple of reminders here. Certainly there are no facts about the future, and of course, past performance is no guarantee of future results. But you deserve to have a serious, unhurried conversation about this. And we don't want to wait until the next crisis to have it. So thank you for watching here today. Hope this has got you thinking a little bit, and certainly we hope to see you soon. Let's get together and talk about this and your situation a little bit more. You can reach out to us on our website by hitting the Connect tab at the top of the page and then the Contact button, or you can email me directly at bbush@horizonfg.com. Again, thanks for joining us. Hope to see you soon. Bill Bush here with Horizon Financial Group. We'll see you.